I've been working with National Insurance, a GI company, for the last 7 years. And today, for General Insurance Insights and Interview Preparation session, we're going to discuss how we can go through the company's financials to understand what the major lines of business that the company operates in, what is the premium volume, what is the growth percentage, and things like that. Now, before I start, just if you could all quickly tell me in the chat or through your microphone, how many papers you've cleared, are you a fresher, so that I can tone down the scale of my presentation today. All right, Yashika. All right, I'll quickly start then, assuming you're all freshers. For today, we are going to discuss the case study with ICICI. All right, you open a new tab, you search for ICICI Public Disclosures. Public Disclosures ICICI Lombard General Insurance. We'll start with 23-24 financial year. So basically what happens is, one second, I'll share my screen. All right, so you search for ICICI Public Disclosures. The first link that you get, Public Disclosure. For today, we are going to be discussing 23-24 annual year FY 24-25. This is how you get to this page. Now, basically all companies have to submit their financial statements quarterly, and this is called as public disclosures. There are various forms that are set formats that IRDAI has given. They have to populate their business in those formats and put it on their website for common people. So this is done quarterly, but what we are going to go through today is the annual disclosure of the year 23-24. So NL stands for non-life set formats. Here you can see there are a list of NLs. NL4, 5 being for premium and claims incurred, 6 is commission, 7 is operating expenses. Today what we're going to do is we'll focus majorly on 4 and 5, discuss a little bit about 6, 7, 2 and 3 as well. All right? Okay, starting with NL2. All right. This is what the format for NL2 is. The first field that we discuss today is gross direct premium. Now, what is gross direct premium? A company has, let's say, a product called ABC Mediclaim Policy, under which it has sold 10 policies. Together, the premium is 1,000 for this financial year. So you'll see that figure here. So that's gross direct premium. The second field that you see is premium on RI accepted. So direct premium in that case, we just discuss A is our company, B and C are the other two companies in the market, let's say. For that one product, I have collected a premium of 1,000. Now the next field that we saw was RI premium accepted. What does that mean? before I move to that topic, do all of you have a fair idea of what reinsurance is, or do you want me to touch base on that as well? You'll have to put it in the chat for me to know. No idea, yes. All right, Yash. We know. All right, so Yash, we'll just quickly cover what reinsurance is. Basically, let's say you have a health insurance policy. All right. Now, when you buy an health insurance policy, you transfer that risk to an insurance company. Now, insurance company writes thousands and thousands of these policies, so it has a portfolio of a lot of risk in its hand. So, what insurance company does is it also insures this portfolio with another reinsurer. So, insurance of insurance business is reinsurance. All right. The insurance company also transfers a little bit of risk to another company, and that business is called as reinsurance business. So now let's say another company has written 500 rupees worth of direct premium business, out of which it wants to transfer, let's say, 50 rupees. And it has transferred that to us. So this will come down here as RI premium accepted by our company. Now the third field will be RI premium ceded. Now what does that mean? Just like company C had ceded 50 rupees of its premium to us, even we can cede something to the other company. Let's say I have a portfolio of 1050 rupees right now and I decide, okay, I will cede 30 rupees. So what's left with us is 1000 plus 50 minus 30. So 1020. That's our net written premium. So we've discussed right now gross direct premium, premium on RI accepted, less premium on RI ceded. Then what we get is the net written premium.
Ma'am, can you explain the premium on reinsurance ceded?
Can you say that one more time?
Ma'am, premium on reinsurance ceded. Can you
All right.
explain?
Did you get the idea of what happened when C company gave 50 rupees of its premium to us? Did you understand that bit?
Ma'am, actually, I just joined the class.
All right. Okay, today we are discussing the NL forms, which are the public disclosures by companies. It's a set template, and we are going through those templates and what each of the fields mean. The first one is the direct premium, which in our case is 1000. We are company A. We've received 1000 premium by selling n number of policies. All right. Now, do you understand the concept of reinsurance?
Yes, ma'am.
All right. So there's another company in the market that has written a premium of 500 and it has reinsured its business with us and by giving us a premium of INR 50. So this premium comes here 50.
Yes,
Next,
ma'am.
similarly, we have also decided, okay, I don't want to keep the entire risk with myself. I want to give away some premium. I want to give away some risk. And for that, we'll have to cede some premium to another company. And I've decided, okay, I will give 30 rupees worth of premium. So what's left with me, which is the net written premium, is 1000 plus 50 minus 30. So the net risk that we have on our business is 1020, which is also known as the net written premium. Understood? Any doubts, anyone?
Yes, ma'am, got it.
What about others? You'll have to show me a thumbs up or something of that sort so that I know and I can move ahead. Okay. Okay. Now you'll see there are different lines of businesses. What do we mean by lines of business? Fire, marine cargo, marine hull, motor, ODTP, health, others, PA. All of you must be aware of at least these basic two forms of insurance, one being motor and the second one being health. Most of us do have health insurance. Also, when we buy a new vehicle, we are compulsorily told to buy a motor TP policy, and most of us also buy motor OD policies. So these are types of lines of business that companies write. So fire, marine cargo, marine hull, OD, TP, health, and so on. These are the different types of lines of business ICICI Lombard is writing. This one is a set template, and maybe in some companies you'll find credit insurance is zero. So basically, they're not writing that line of business. So this is what different lines and its premium mean. Now, let's say if you're interviewing for ICICI Lombard, we should know what the major lines of business that ICICI Lombard writes. First of all, what is the total business volume written by it? This form is in lakhs, so we know this figure, grand total up to FY for Q4. Now we are interested in up to financial year 23-24. The company writes 24,776 crores worth of direct premium in financial year 23-24. These are few figures that you should know. Knowing this will give you an edge in the interviews, definitely. So the company writes 24,000 around 25,000 crores of premium. Its RI acceptance business is 818 crores, and it also seeds 7,500 odd crores of premium. What's left on its net account is roughly 18,165 crores. This is how you read these four figures. Okay, so what is the premium volume? What's the by premium volume? We can comment on direct premium, the RI business it has accepted, and out of all the business that it has accepted, what business has been ceded to other reinsurers, and what's the net business that remains with ICICI Lombard. So this figure tells us that the net written premium. Okay, that's one thing that you should know. Next would be, okay, if I ask you what is the major line of business, how do I get to that and what is it called? In technical terms, it's called the business mix. So let's talk in terms of direct for now. The company is writing around 25,000 crores, out of which 6,000 crores, 6,200 crores of premium is coming from health insurance. So business mix for health would be 6,200 by 2,500. So 24.8%. So basically 24.8% of the company's portfolio is made up of health. So we could break down the 100% of premium into different lines of business. That is called as the business mix. So you will see more than 60% of the business roughly for any insurance company comes from motor and health business. So you should know, okay, while you're in an interview, you can say things like, okay, seen around 25% of the business comes from health. And this will not just help you in the interview, but later on also, these are very common terms while you're preparing any reports, or the initial task that you will be or can be assigned in a company will be to calculate, okay, tell us what the business mix of some other company is. In that case, you can go through their forms, you can go through the NL2s and build these reports on your own. Okay, the next thing that you should know is growth rate. As simple as it sounds, the premium clocked, let's talk in terms of net written premium now. For financial year 23-24, the net premium was 18,150 crores. The corresponding figure for 22-23 was 15,539 crores. So what is the growth rate? So you can remember the growth rate from, let's say if the premium grows from 100 to 120, simply growth rate of 120 over 100, that's 20%. 120 over 100 minus 1, 20%. So you also need to know, okay, the company is growing at a rate of 20% per annum. This can also be done for the company level as well as for the major LOBs. So you can comment on basically on lines such as health or motor OD or your TP business. Okay, it's year on year growing for at 10%, 12%. All right. Any doubts, anyone so far? All right. For Q1 and up to Q1, for Q1 and up to Q1 will be the same, because for financial year up to Q1, there's only Q1 experience. You'll see the difference when you get into Q2. So then for Q2 would mean only the months June, July, August, July, August, September, and up to Q2 would mean April, May, June, July, August, September. Anything else? Anyone? Any doubts so far? All right. I am hoping that you guys are noting down, okay, major lines of business. You keep making notes, growth rate, what business mix is, because the next thing that we're going to discuss is called the retention ratio. Right now, our retained premium is 1020. Okay, let's discuss gross written premium before that. What is gross written premium? Gross written premium is equal to direct plus RI acceptance premium, which in our case is 1000 plus 50. So that's 1050. 1000 is our direct premium, 50 is our RI acceptance. Together, these two make up for the gross written premium. That is, in totality, we have written a premium of 1050. A net written, after, what is the difference between gross and net? It is always the RI that we have ceded. All right. So gross, we have written 1050, and net, it's 1020 on our books. So what is the retention ratio? It's 1020 by 1050. So that's 97.14%. Retention, as the name suggests, is if I'm writing a premium of 100, how much am I retaining? In this case, in this scenario that we've built, if I'm writing a premium of 100, I am retaining 97.14% of it. So that's the retention ratio. That is another ratio that you should know of. All right. Next, if we go through the forms, we'll see the terms opening balance of UPR, closing balance of UPR. Is UPR a new term for you guys?
Yes, ma'am.
All right. Okay, what sets insurance business different from the other business that one does? Let's say I'm into a business of selling umbrellas. I buy the umbrella for 100. I incur another 5 rupees expenses on, let's say, rent, electricity, salaries. I sell it for 120. I can for sure say that I have made a profit of rupees 15. and I can book the profit of rupees 15. Right? But how is insurance business different? Let's say a financial year runs from Jan to December. This one person comes up to us and buys a policy for rupees 120. The policy is going to run from 1st July to 30th June, an annual health policy.
Yes, ma'am.
So 120 for a period of 12 months roughly translates to 10 rupees per month. Now let's say we are closing the accounts on 31st December. So far, 6 months have elapsed and 6 months are remaining. Yes or no?
Yes, ma'am.
31st December, from a period to 1st July to 31st December, 6 months have elapsed and 6 months are remaining. So now when I'm closing my accounts, when I'm reporting, can I report 120 rupees and the person has not made any claim so far? Can I book a profit of rupees 120?
No, ma'am.
Why not?
Ma'am, because only 6 months has been gone till now, so we'll write 10 into 6, so 60 will report like.
We can report rupees 60. Perfect. When we started with our accounts, we started with rupees 1000, which in this case is 600, is rupees 120. I'm sorry, 120. And then let's say there was no acceptance and no session, and net written premium is 120. But we can't report this 120 as a profit. We have to bifurcate it. Only 60 of it has been earned and 60 of it is still outstanding. Basically, we still have to provide coverage of rupees 60. So this 60 becomes our UPR, which UPR stands for unearned, because we have still not earned it. It stands unearned premium reserve. So in this case, let's say this is the only policies that we have written throughout the year. 120 rupees is our GDP. Sorry. RI acceptance and RI session both are 0. Our net written premium in this case is 120 and our closing UPR is rupees 60 and my net earned premium is 60. So on net basis, we have earned rupees 60 during the year. Now we go on to the next year. We've written, let's say, another policy of 150 rupees. RI acceptance and session is again 0 and 0. Our net written premium is 150. Now we'll be earning this 60 rupees in the next financial year. This is the next FY. So I will add that figure here, and assuming this policy of 150, out of this 75 is still unearned, we will do 150 plus 60, which was the closing UPR of the previous year. It becomes the opening UPR of the next year. This we will earn during this year. That is why the plus. And out of this 150, 75 is still unearned. So that becomes your closing UPR for this year. So what will be the NEP of the next year? And how did you get to 135, Devansh?
Ma'am, 75 plus 60.
Could you break 75 for me?
The 75 being the closing UPR and 60 being the opening UPR.
All right. I'll just
150
repeat
minus
myself.
75 and plus
Perfect.
16.
Right now, because we had assumed only 50% of the business is unearned, and that is why 150 got down to 75. Okay, I'll change the figures a little bit. Let's say the net written premium is 150, the opening UPR is still 60, and the closing UPR is 50 only. It's just 50. So then, what will be the net earned premium for the year? I'll repeat myself. Net written premium is 150. Opening UPR is 60, and closing UPR is 50. All right, Naman, just tell me, how did you get to 160? So, all right. So, if everyone has followed the concepts that we've discussed so far, you have understood NL2 completely. NL2 gives us figure for the period up to the uh, up to the quarter for that financial year for different LOBs that the company has written. It gives us what values? It gives us the GDP, the premium that it receives, that a company receives from selling its insurance policies, premium on RI accepted, what other companies cede. There's some other company that accepts it. If we are the one that is accepting the business, the premium will reflect here. Now, if we are ceding some risk, that premium comes here under the head premium on RI session. What's left is net written premium of the for the year. We add the opening balance of UPR because that becomes the earning that is coming from the last financial year for us. So that is why we add the UPR and we subtract. Okay, this you have written 631, but out of which you have not completely earned. And what is the portion that you've not earned? You've not earned 448. So we'll subtract that, and what's left with us becomes the net earned premium. Further, the format also asks the company to bifurcate. Okay, you're saying 3368 worth crores of premium. Just bifurcate into how much you've received in India and how much comes from abroad. So in case of ICICI Lombard, the entire business is written in India. So these two figures are identical. Any doubt, anyone? All right. So we are done with NL4, which is premium. Okay, one more thing. When we say UPR, UPR is made up of two things. One, we've just discussed a simple case scenario where 6 months have elapsed and 6 months are remaining. So 120 out of 120, 60 stands unearned. It is also made up of PDR. What is PDR? Premium Deficiency Reserve. Now, why am I discussing this separately with you all is because this is where the role of actuarial comes in. And how? Premium deficiency, again, as the name suggests, is in this case it was rupees 60, but the actuary comes in and says, I don't think 60 will be enough. We need 75 rupees. I think this person is going to make a claim of rupees 75, and what you're setting aside, which is 60, will not be enough. In this case, the company will have to build an additional reserve of rupees 15. This rupees 15 is called as the PDR. And when they're making the accounts, they will not make it for INR 60 anymore. They'll do net written premium of 125 and UPR of rupees 75. So NEP in this case would be 45, and the opening of the next year again will be INR 75. So UPR or URR as they call it is made up of, first component is the unearned portion on pro rata basis. There are various methods to calculate it. We'll not go into that for now. So the first component is the unearned portion, and the second one is the premium deficiency reserve. As the name suggests, if we think that the unearned premium is not sufficient and we need extra funds to support that business, to support that risk, we make a premium deficiency reserve, and that also comes under opening balance of UPR or closing balance. Basically, we make a closing balance, and for the next year, that becomes the opening balance. So this is all that you should know about NL4, at least for now. Now, we'll go to the next NL, which is NL5, claims incurred.
Ma'am,
Yes?
ma'am, we are changing the UPR from 60 to 75 because there's a high chance that there will be a claim in the next year from that policy.
Yes.
Okay.
Now you have to think that the company eventually is not going to write just one policy. We are going to write lakhs of policies. Let's see what the premium figure for health is. It's 6,171 crores. All right. So whenever we build a PDI, it's not at a policy level. We see, okay, in the past, what we've charged is not sufficient. The inflation is high. Calculation of PDR is another topic that I can go on and speak for at least 30 minutes. But now, for now, you should know that, okay, in the past, per policy, I've charged 100 rupees. And then I gave away 80 as claims on an average. 20 was my commission expense. Then there was some expense element. And in the future, there's going to be inflation. So this 100 rupees is not going to be sufficient. This an actuary can speak if he has the right data, if he or she has the right data, right? Basis that on an overall level for the health portfolio, it can say, I think this amount of UPR is not sufficient. I need a little top up on top of it. I need another 100 crores for PDR because I think what you're setting apart for UPR is not sufficient. So please build a PDR. And this is the role of an actuary to calculate the PDR figure.
Yes,
All right.
ma'am.
Anyone else? Any doubts? Yes, they are. Because they are reserves that we've created for policyholders. It is a liability for the insurance company. Okay. Next, we move on to NL5 claims schedule. We've already covered the concept, so I don't think you learn anything new in this sheet. Claims paid direct. Now, whatever direct business we had written and denoted year, now whatever claims we pay for this business is reflected here. Not necessarily only for the insureds that are covered under this. In the past also, if I've written any direct policy for fire line of business and during this financial year, I've made a claim, I've paid a claim, all of this will come here. So claims paid, simple. for direct business. Now, similarly, I had also accepted RI business from company C. So let's say there were 100 insureds for company C, out of which 2 made claims. So they came and collected money from company C. So because we had reinsured company C, we will have to give a part of it to company C. So any amount paid corresponding to this transaction, to the relation we have with company C, any amounts paid for that comes under this head. Add RA accepted to direct claims. Why are we adding it? Because it is a liability for us. We had accepted the premium, and now anything that we pay for these claims, for these risks, is a outflow for us. So in financial year 23-24, ICICI paid 1138 crores worth of claims for fire line of business. For the direct business it wrote. For the RI acceptance business, it gave away 30 crores. Next. So what's 30 crores for company C? Because it has recovered it from us. We are paying, but we also had reinsurance. We had given away 2,922 crores of premium as reinsurance. So now if other companies are coming, our risks are coming and making claims from us, we will also ask the reinsurance to pay a part of it. This part is reflected here. So basically, we had asked reinsurers to pay 873.4 crores worth of claims to us. So what will this do? This will reduce our payout. So that is why we subtract it. Less reinsurance ceded to claims paid. So to our direct customers, we paid 1138 crores. To the RI business that we had accepted, we had to pay 29.5 crores. And we also bought reinsurance for ourselves. So corresponding to these claims, we are asking our reinsurers to reimburse us 873.4 crores. So on a net basis, what's left with us is 294.35 crores. So that is the net claims paid amount, 294.35 crores. Any doubt?
No, ma'am.
Everyone? Excuse me. All right. So the next bit then. You'll see claims outstanding at the end of the period and claims outstanding at the beginning of the period. All right. We are in year 1 right now of our company's operations. So beginning amount for now is 0. Okay. Let's say we are closing accounts on December 31st. A car met with an accident on December 30. Met with an accident. It informed us about this claim on December 31. We have not paid the claim yet. Because the car is still in a garage, it is getting serviced and we don't know what the claim amount is. But our surveyor has told us, okay, I think the claim amount is going to be 20,000. So can I ignore this amount when I'm closing the accounts on December 31st? Because so far we've only discussed, in the claims part, we've only discussed paid. But it does not fall under the category of direct paid because we have not paid. Similarly, it does not fall under RI acceptance or RI session paid amount because it is not paid yet. So can we just simply ignore 20,000? No, we can't. We will build an outstanding provision for it. An outstanding provision of 20,000. So over here, you will see add the claims outstanding at the end of the period. Why are we adding it? Let's say during the year we paid 1 lakh worth of claims in motor line of business. And I know there's one claim that stands outstanding for 20,000. So actually the claims that were incurred during the year for me was 1 lakh plus 20,000. So that's 1 lakh 20,000. And that is why we are adding the claims outstanding at the end of the period. Everyone understood this bit? Why we are adding the claims
Yes.
outstanding at the end of the year? All right. Don't ever think of, okay, it's an outstanding at the end of the year figure. That is why we should add it, or what should we do with it? Because in premium, if you remember, we were subtracting the closing outstanding. So never think of it like, okay, it's a closing provision figure, we'll have to add it. Just think logically. What was closing figure for premium business? The business that we've not earned. So it should reduce our earning for the year. That is why we were subtracting it there. In the case of claims, 20,000 I should have paid, but I've still not paid. So it should increase my liability. All right. It should reflect as a negative figure. It should increase the negative figure. So that is why we are adding the 20,000. The closing outstanding provision gets added to the claims paid amount. Correct? Or do you want me to repeat that one more time?
Yes, ma'am, got it.
Just think of it logically. Okay. Now again, what is the role of actuary then? If the surveyor has told us, okay, if the surveyor has told us 20,000 rupees is the claims provision, your outstanding provision is 20,000. So closing outstanding provision is 20,000 and done, and then we can close the books. No, we can't. Why? Because of IBNR. What is IBNR? This is one of the most important roles of an actuary in a GI company. One of the most important roles is calculating IBNR reserve. What is IBNR? It is incurred but not reported reserve. Okay. Incurred but not reported. Let's say the car met with the accident on December 31st. It did not come and tell the insurance company right then on December 31. On December 31, company A is unaware of this claim. If it was aware, then it would have sent a surveyor to the spot, got an amount of provision, built it in its accounts. But right now, we are unaware of this figure. So, the role of actuary is to calculate, okay, what figure for IBNR should I put in the accounts? What are the claims that are incurred, but the company is unaware? It is not reported to the insurer yet. So for my company, the figure, all right, I'll make you guys guess. My company has around 15,000 crores of premium, 15,000, 16,000 crores of premium. What do you think can be the IBNR amount for a company? It's been in operation for the last 100 odd years. So what do you think can be the IBNR figure? A rough guess. Basically, the amount of reserves that the company thinks, okay, these claims have incurred, but I don't know about it. All right, 1,200 crores. Others?
Ma'am, could you repeat the number?
All right. My company is writing roughly about 15,000 crores and it has been operation for the last 100 years. Others? So for a company like ICICI Lombard, which is writing business of 12,000 crores, the IBNR figure is close to 14,000 crores. So this is a very significant amount. You might think that because I gave an example of an accident occurring on 31st December and we are unaware, so roughly for a period of 5-7 days, the company is unaware. But for lines such as motor TP, you'll see that the company is unaware about the claim even 10 years after the accident has occurred. So IBNR becomes a significant proportion in these forms. Let's just look at motor TP for now. The company has written 2,074 crores worth of premium. Claims paid amount. I'm so sorry. Motor TP premium was 4,900 crores and the IBNR figure is close to 11,000 crores. This is only possible because motor TP is a long tail business. What do they mean by long tail business? That you are unaware about the claim even 12 years after it has occurred. So the IBNR component becomes a major component of the outstanding provision. You'll see out of the 20,000, basically let's assume the claim amount was 20,000. The actual outstanding provision was 20,000. So 17 out of 17433, 10985 is because of IBNR alone. So calculating the IBNR figure is one of the major tasks done by an actuary in an insurance company. So outstanding provision made up of two components. For now, simple basic claims that we know of, which is the outstanding provision. And the second element is your IBNR claims that have occurred, but the insurance company does not know about it. Steps in the actuary, calculates the IBNR figure at the line of business level, gives it to accounts so that NL5 can be made. So claims outstanding at the end of period, this figure, two components, claims that you know of and are outstanding, and claims that you don't know of, but the actuary has told you, I know there's a claim somewhere that you don't know about, and for all these claims, the IBNR figure is so and so. Yes, they are. Yes, they are. Even when the government rules say, okay, you shouldn't pay claims after 5 years, when these cases go to courts, the court tell the insurance company, okay, you'll have to pay so and so amount. So we pay claims that are 20, 25 years old as well. See, good question, Mitali. But Mitali's question is, but every year their policy is getting renewed. So how after 12 years? Okay, let's say I have insured your vehicle from 2005 every year. All right. So 2005 was the first time you gave me a premium, then 2006, 2007, 2008. But in 2006, and now I'm closing the accounts for 2024. But in 2006, you were involved in a hit and run case. You did not tell the company about it. But now that person has surfaced and told me, okay, on 1st August 2006, Mitali's car hit me and I am now making a claim. So I can't now. I don't know if in 2024 you'll renew the policy with me or you'll not renew the policy with me. But this claim is coming from the coverage that I gave to you back in 2016, 2006. So that is why 20 years. Oh, it gets proved. There are many cases that go on and it happens. People give evidences and it happens. Mitali, does that answer your question?
Yes, ma'am.
All right. So I don't know. You basically were renewing with me for 12 years in your example, but there was a chance that after 2-3 years, you gave away with that car and now you own some other car which is with some other insurance company. But for me, that liability still stands. I am still liable to pay for what you did in 2006.
Yes, ma'am.
And because this claim did not surface in 2023, it was there. I had anticipated that some of the people that I had insured have not told me about these claims. I had built up an IBNR reserve. Now, when in 2024 I am told about this claim, I build an outstanding provision for it and my IBNR gets reduced. So, as we move ahead, IBNR for older years keeps on decreasing, but it is compensated by the IBNR for new years, for the recent years. Does that make sense? Because more and more older claims will resurface. I'll know about it. My incurred but not reported will come down because they're getting reported. So IBNR will come down, but instead either the outstanding provision will increase or I would have paid the claims. In that case, the paid amount would have increased. You're not lifelong for everything that that person has done during the year that you had insured them. So if I'm issuing a policy to you, Hemant, for year 2024, anything that you do in 2024, let's say we're talking about a motor TP policy for now. So any accident that you get involved in the year 2024 becomes my problem. Yes, for that year only. If I am your insurer in year 2024, and let's say you go to ICICI Lombard the next year, and if you meet with an accident in, I shouldn't say it, but let's say you meet with an accident in 2025, that becomes an ICICI's problem, ICICI Lombard's problem. It's no longer my problem because anything that you do in 2024 alone is my problem. And for anything that you've done in 2024, you can come down in 2030 also and tell me that, okay, such and such thing is had happened in 2024, reimburse me. Now, when I say this, that I am liable for so many years, usually these cases come only in motor TP. The other most common example is health insurance policy. So usually the IBNR period is around 6 months for health, not more than 6 months. The insurer comes to know about the claim within 6 months max of happening. Most of the times, okay, what happens in health insurance these days is whenever there's a planned surgery, basically planned surgery would mean something like a knee replacement. I know that I'm going to get it done day after tomorrow. So what I do is I will have to go and tell my TPA, or the people at the hospital will inform your TPA and your insurance company, okay, this person is coming and getting this knee surgery done. So the claim gets automatically reported to the insurance and the IBNR component in such lines of business is low. Similarly with motor OD as well. OD stands for own damage. So basically whenever you meet with an accident and let's say there's something wrong with your right door and you get it fixed, that comes under your motor OD policy. So when you get it fixed, you will tell the insurance company, okay, send me a surveyor to evaluate the extent of loss. So the company knows about the claim. So in these lines, the extent of incurred but not reported is really low. For claims such as motor TP, these lines are very long tailed. Liability lines are very long tailed. We'll discuss LOB wise in the next sessions. But for now, IBNR component is extremely high for motor TP. because the claims remain unreported for many years. Anything else? Okay. So going back to the NL, claims paid direct, claims paid for RI acceptance business, less claims paid, basically the recoveries we'll make from reinsurance is net claims paid. Next is claims outstanding at the end of period. We are adding it because these are additional liabilities that have not been paid so far. Next item is closing outstanding of the current year becomes the opening outstanding for the next year. So let's say if I'm saying 721 crores is the closing outstanding of the next year, it becomes the opening outstanding of the next year and we subtract it then. So 721 will become the opening outstanding of the financial year 24-25, and at that point we are going to subtract it. Then again, net claims paid plus closing outstanding less opening outstanding becomes your net incurred claims amount. So that is the earned equivalent in claims. This is what we've earned and this is what we've incurred. So then we can compare, okay, Mitali, we'll cover this in the next session at length. Do you want to know, okay, how a claims get reported? Then it can either be settled via Lok Adalat or it can go into court cases. If you want to know the entire process, we'll discuss it at length in the next class.
Okay, ma'am.
All right. Okay. Then we've covered two forms today, premium and claims incurred. Okay. Whenever we buy an insurance policy, usually we're buying it through an agent or maybe let's say Policy Bazaar or any other web aggregator. So the insurance company, how is Policy Bazaar earning? Because the insurance company pays a commission to Policy Bazaar. The insurance company gives a commission to the agents. Why do agents keep calling us, okay, buy this policy, buy that policy? Because they'll get a commission from the insurer. So that those figures, those financials fall under NL6 commission. Now again, similar pattern. Commission and remuneration, reward, distribution fees, gross commission. So whatever we've incurred for the direct business comes here. This is all that you need to know. Commission is a flat percentage or whatever arrangement the insurer has with the agent or web aggregator falls under this head. Rewards is okay if your business operates at a certain loss ratio. It is not loss making. We'll give you something else. Distribution fees, any fees that the company incurs for selling of policies comes here. But the total outflow is gross commission. This is what we've given to acquire the direct business. Add commission on RI acceptance. Again, we'll have to give some commission. Let's say company C gave us some of its business. For company C to get that business, it must have paid some commission to some agent. We'll reimburse that to them. Okay, you had incurred, okay, for 20, you had incurred 20 rupees of commission, 2 rupees of commission. Okay, here, take those 2 rupees from me. So that comes under commission on RI accepted. Similarly, reciprocal for us under RI ceded. The reinsurer will also give us some commission back. It will reimburse the commission to us. That comes under this head, commission on RI ceded. So here, and again, your net commission would become commission paid for direct business, commission that you have paid for the RI acceptance business that you have accepted, and then some of it gets reimbursed by the reinsurer. So we are subtracting that under this head to get to the net commission. So that is your net commission figure. Understood?
Yes, ma'am.
All right. If it's okay, I'll take 10 more minutes to discuss at least expenses and some more ratios, if it's okay with everyone. All right. So the next NL is NL7, operating expenses. We will not go into detail, but as the name suggests, there will be certain expenses, salaries, rent, electricity bills, management expenses, basically, that the company incurs to support all of this insurance business. So that is the figure that comes here. So that is your total expenses, which can be found in NL7. So 4 NLs that we have discussed today: premium, claims incurred, commission, and operating expense. These are the 4 NLs that you can go through before you appear for any interview. Okay. We've discussed gross written premium, quick revision, direct business plus RI acceptance. So a total of the business written by the company, either through its direct channel or through its RI acceptance channel. Net written, what's left after you've ceded some of the gross written premium to your reinsurer. Net written. Business mix, okay. Health in our case was around 28% of the total business. Motor, OD, TP combined can be around, let's say, 35%. So that is what the business mix is. Growth rate, simple as the name suggests. Last year I was doing 100 crores of premium. This year I've clocked in 110. Growth rate 10%, can be looked at the company level, can be looked at the line of business level. Next is your retention ratio. Okay, you've written a premium of 80 plus 20, direct 80, 20 RI acceptance 100, out of which you've ceded 5 to the reinsurers. Your net return becomes 95. So your retention ratio in this case is 95 over 100, 95%. Next is loss ratio, gross and net. Your gross earned premium for the year was 100 and your gross incurred claims is 80. So basically, for every 100 rupees that you earn, you pay out 80 as claims. Not necessarily just payout plus provision, but for these 100 rupees, you will have to eventually pay 80 in ultimate. So your gross incurred claims ratio is 80 over 100, that is 80%. Similarly, net earned premium on a net basis. So basically, this is for your direct plus RI acceptance business. We are not thinking about what we've done with regards to reinsurance. We are not thinking about it. On the gross level, what we have done as insurers, we've earned a premium of 100 and for that we think the payout is going to be 80. Our gross incurred loss ratio is 80%. Now on a net basis, our NEP is, let's say, 80 and our net incurred claims is 60. What will be my net loss ratio? It's 3 over 4, so 75%. My net loss ratio becomes 75%. Now, this particular loss ratio, you should be aware of the net loss ratio, just the net loss ratio at least, for the company level, at the company level, okay, when ICICI earns 150, it gives away claims of about 120. So this is the net loss ratio. And you can also, when you find out the business mix and you identify the top 3 lines of business, okay, first is health, second is OD, third is TP. What are the loss ratios for these 3 lines at least, and at the company level? When you earn 100, you pay away 80 in the form of claims. So your loss ratio is 80%. Got it, everybody?
Yes, ma'am.
The loss ratio. Similarly, the next one is commission ratio. What is commission ratio? How much commission are you paying on an average? So to write a business of, let's say, 100, to get a business of 100, I am giving away 5 rupees as commission. So a simple 5 over 100 is your commission ratio. So, and why are we calculating it? There are three main elements. When an insurer gets a premium, it will have to give the majority of it away in terms of claims. Second will be the commission it has to pay to get the business. And the third one is the expenses to keep the show running. The expenses incurred to keep the show running. So first element is your loss ratio. Second, we've just calculated the commission ratio. And the third similarly is the expense ratio. Okay, to get to 100 rupees of premium, we have to pay away 5 rupees as expenses. It could be for salaries, for rent, and the other bills that the company pays. So your combined loss is 80 plus 5 plus 2, 87. So that is your combined ratio. Understood, everyone?
Ma'am, could you repeat this combined ratio?
All right. Once I get the premium, what are the three outflows? One is your claims. I have got this premium. Now, what will the company do with this premium? First bit is your claims. The majority of premium goes into servicing of claims. The second bit is the commission it had to pay to get to that 100 rupee business. And the third is the expenses that the company has incurred. Claims plus commission plus expense. Perfect. So the three ratios combined are called as the combined ratio for a company. And the company is profitable if the combined ratio is less than 100%. Only then the company makes money. No, if I collected 100 rupees and I've paid 80 claims, 10 commission and 20 as expenses. So for every 100 rupees, if the company is giving out 110, it becomes loss making.
Yes.
So a lower commission combined ratio is favorable for the company. Again, there are other elements such as you can say, okay, but the company got the premium in the beginning of the year, it can invest, make some money. But at a broad level, you wouldn't want your combined ratio to cross, let's say, 80, 85, 90. You would want to keep a cushion because the company wants to make profits. The company is in the business of insurance to make profits at the end of the day. So a lower combined ratio is favorable.
Yes.
All right. So I think for now we can end today's session. In the next session, we'll be covering the lines of business. Just as we discussed motor TP today, we'll be discussing other lines, at least the major ones, in the next session. So any doubt for today's session? Anyone? All right
In
then.
case of motor TP, how they are giving the claims after 12 years, like how this process, like.
All right. Okay. We'll be covering this at length, Mitali, in the next session. But you have to understand. Okay, I'll give you a little bit about motor TP. Motor TP is one insurance that is compulsory. I'm not sure if you're aware or not, but you can ask your elders whenever you buy a motor vehicle, be it a two-wheeler, a four-wheeler, or a big commercial vehicle. Also, you need to mandatorily buy a motor TP policy. What does TP stands for? Third party. So basically, when you get into an accident, when someone gets into an accident and injures its own vehicle, gets in and scratches the dashboard, mirror breaks, engine stops working, all of that is covered under own damage, motor OD policy. TP policy, on the other hand, is for what you've done to the third party. Let's say there was this person standing, you hit your car, he's dead. Now, the claims that will arise from this will be covered under motor third party. So the government is interested in the well-being of the society. It's not interested in the well-being of your car because you are there to take care of it. But the government wants that if such a thing happens, then to protect the society, you need to have motor TP. That is why, excuse me, that is why motor TP is compulsory. Let's say you've hit a man and now the entire household was dependent on that one man. Now you are liable to make good to that family for the loss that they have incurred because of the loss of that one person. That is why, and there's a possibility that you yourself are not in a condition to make good the losses that this person has make good these losses. So that is why having an insurer brings in that safety cushion to the government that, okay, if such a thing happens, the insurer will take care of it. And that is why we all have to get a motor TP policy when we buy a motor vehicle. So now, even if this claim surfaces 10 years later, the family of the deceased is still interested in getting in that amount. So you can think of it as social welfare, not necessarily social welfare, but just think of it. Okay, the family was dependent on this person. This person is no longer there because of what my car has done to this person and the effect it has on the family of this person. That is why even after 12 years, if this claim comes up, the government expects the insurance company to make good the losses. All right.
Yes, ma'am.
That is why in motor OD and in health, because our personal interest is at stake, we immediately go to the insurer. Okay, give me the money. I have incurred these many expenses on my medicine bills, or I had to get my car painted because of so and so reason. We go and we get the claim. But motor TP is for the benefit of the society, of the people who are around our car. That is why if they are at loss, the government expects the insurance company to make good the losses, even after so many years.
Yes, ma'am.
Okay, Yash, my name is Poorva. I've been working with National Insurance Company for the last 7 years, which is which is a pure GI company, and I've cleared 14 papers as per the old curriculum. My SA3 is still remaining. Anything else that you want to know? Nothing. Anything else, anyone? Or I'll end the meeting now. All right then. Thank you, everyone. Have a good day.
Thank you, ma'am.